Look around you, different things born out of truth and passion. Business software, it's our craft, our identity. Thoughtfully engineered, passionately designed to help you transform your business. Zoho, made in India, made for the world.
Hi, good morning. How is it that you're digesting the possibility of a US government shutdown and what the repercussions could be on various asset classes?
Hey, good morning, Aisha. It's always great to join. And the shutdown of the U.S. government isn't that surprising. I think markets have largely been positioned for continued dysfunction, at least in the legislative branch of the U.S. government. So I don't think that much changes. When we look historically at past government shutdowns, we haven't seen significant market reactions one way or the other. In fact, in 2018 into 2019, the market had double-digit gains between the start of the government shutdown and the end of the shutdown. I'd say the most similar period to this is back in 2013, where we did miss a non-farm payrolls as a result. And at that point, the max drawdown of the market was 2.5%. So it's not that big of a deal. I think it's more noise. And I encourage investors to fade the noise and really focus on the fundamentals, which is that we're likely going to continue the easing cycle of interest rates in the U.S. into a backdrop of rising earnings. This rarely happens, historically speaking, and it's a very, very good environment to be risk on in the market and continue to invest in a lot of the durable growth themes that have been working. So I remain bullish on U.S. equity markets. I think the pressure on the dollar can continue to benefit emerging markets going forward. And I also like gold as a portfolio ballast because it benefits from a lot of this dysfunction. But gold has also been a beneficiary of strong central bank demand and really increasing retail investor demand as well. So there's a lot investors can do and take advantage of should the market sell off on these headlines.
Matt, in the midst of all of this, I'm trying to understand, and hi, this is Harsh here, good morning. In the midst of all of this, and good evening for you, in the midst of all of this, I'd want to know what the risk to this thesis playing out actually is. What would deter the Fed from cutting rates, if at all? And a possibility to that could be tariffs and what the impact of that on inflation. Give us a sense of what those risks are according to you and how likely are they to play out, because that could really be a spanner in the works to all that you're talking about, gold, currency, as well as growth. So trying to understand your take.
Yeah, absolutely. Good morning, Harsha. And I would say first and foremost that I think tariffs are probably the red herring in the situation. It's not to downplay the risk that tariffs could have with the slower feed through to inflationary pressures, but the bigger challenge for the inflation numbers that we've been seeing coming through is actually services inflation, not core goods inflation. So I think the pressure that we have in the wage force, the potential read-throughs of immigration changes, I think that has more of a potential to lead to persistent sticky inflation than do tariffs. I think the biggest risk to the Fed cutting cycle that's baked into the markets are priced for a little less than 2 cuts this year. My expectation is that we do see 2 cuts this year. The biggest risk is if we do get non-farm payrolls on Friday, that there's a blockbuster print, say a print of 100,000 jobs or more. I think that will cause more significant repricing in the market. I think that will cause an appreciation of the US dollar. And so I think that bears a larger risk. If that does play out, I do think, again, it's temporary because we have been in a rate cutting cycle for over the past year. It's just taken a long time to play out. And again, this is why I encourage investors, number one, to be balanced, not only across sectors and industries in the US, but across geographies, because there's a lot of high quality companies that really aren't dependent on the path of interest rates to do well. And they'll benefit once earnings season starts to pick up in a few weeks, and you can get in at a cheaper price if you're lacking exposure to, say, some of the AI beneficiaries or financials, which I think will continue to do well on M&A, not so much just the rate theme.
Matt, a little bit of take on U.S. markets as well. We've seen market cap to GDP breach levels which we've never seen in the past. And and this, I would reckon, would include the 1929 Great Depression as well, because we are 200% plus on that metric. Does that worry you at all? Do you think that there's a bubble out there? And if so, is it largely AI driven, and are all of the other sectors largely okay in terms of valuations? Sorry, it's not an Indian market question, but just great to have a perspective on where US markets are headed according to you.
No, it's a great question, and I get that from a lot of our clients, globally speaking, because when you look at the U.S. market, it seems that it never stops climbing that wall of worry. But to answer your question directly, absolutely not. I do not think there's a bubble on artificial intelligence, and I think it's really for three key reasons. Number one is the strength and resiliency of earnings growth across not only the mega cap tech names that have been the biggest direct beneficiaries of the AI trade so far, but the broader market itself has in fact continued to benefit from the growth and resiliency of the U.S. economy itself. And that's really pushed up the overall market capitalization of the U.S. I think the second reason why it's not a bubble is because there's not really any debt to speak of. In order for you to have a bubble, you have to have a debt-fueled cycle where you're using debt to invest in areas that are not returning earnings or cash. And that's absolutely not the case of what's happening today. These companies, the hyperscalers, that are going to invest $380+ billion in CapEx this year alone into the U.S. economy, are doing so largely with cash that they're generating from their operations. Their interest coverage ratios are the highest I think I've ever seen in history. So these are very, very high quality companies. And I think the third reason why this is not a bubble is because I would argue that really sentiment is not euphoric across the board. There's still, believe it or not, a lot of skepticism out there and a lot of investors who are not fully invested in this trade, especially at the institutional level, which is why you see so many large cap core and large cap growth managers in the U.S. lagging their benchmarks because they're not completely levered to that theme. So I still think there's a lot of tailwinds going forward and a broadening that's likely to play out.
Okay, on that note, let's move forward. Matt, always good to have you in the show and good speaking with you.
Thank you.
Okay, the GIFT Nifty, absolutely a flat start. But before that, just one macro data point. The fact